Welcome back to the Wall Street Podcast. Today, we're dissecting Goldman Sachs International's report, Investing in Europe's Moment, which was released just this September 1st, 2025. Now, this analysis, it really dives deep into European equities, looking at performance, valuation, investor positioning, and the critical role of earnings drivers, especially currency effects. It culminates in some specific sector recommendations.
Right, and the core question, really, is whether this is genuinely Europe's moment for sustained, broad outperformance, or perhaps do the headwinds the report itself identifies and the sort of nuanced market dynamics mean investors need to be much more selective, much more cautious.
Exactly. My take, drawing from the report, is that the data points towards some compelling opportunities. You've got attractive valuations relative to other assets, improving European economic growth forecast for 26 and 27, and this strategic diversification push, potentially shifting capital from the U.S.
And while I see those pockets of opportunity, my perspective is shaped more by the significant earnings downgrades we've seen, largely because of that currency strength, and the fact that absolute valuations, well, they're historically quite high. This combination, I think, demands a highly selective, risk-aware approach, not necessarily a broad buy into the whole European market.
Okay, so that brings us to a key point in the report, this projection of a 5% price return for the STOXX 600 over the next 12 months. How do we reconcile that forward look with, well, a market that's been essentially flat since March, and particularly with those EPS downgrades you mentioned?
Well, I understand the skepticism, given the flat performance, but the report does build a case on relative value. Look at the STOXX Europe PE. It's 14.4 times. Yes, that's in the 70th percentile historically, meaning it's often been cheaper. But crucially, it still looks inexpensive compared to, say, sovereign bond spreads or the EUR high-yield spread, and especially compared to U.S. equities. So this relative gap, combined with the prospect of better European growth in 26-27, it suggests a plausible path for upside.
Okay, I see the relative value argument, and that search for yield is definitely a factor. My concern, though, is whether relying just on relative metrics might be overlooking the fundamental earnings challenge. I mean, the consensus EPS growth for 2025, it's been slashed from about 8% initially down to minus 1% now, a contraction. So an absolute valuation in the 70th percentile, as you noted. Doesn't that suggest limited room for re-rating? Doesn't this fundamental earnings weakness sort of undermine that relative story and argue for caution?
It certainly complicates it. And this feeds into the currency issue, which Goldman flags quite prominently. They forecast the Euro-USD climbing to 1.25, identifying it as a significant drag on aggregate EPS. So how profoundly does that currency dynamic really change the game for European stocks?
It's undeniable, the currency drag, especially for those big exporters, the foreign exposed names. But the report also points out the resilient earnings in more domestically focused stocks, their GSTFISC basket, for instance. And interestingly, if you convert everything to US dollars, European and US EPS growth have actually been almost identical over the last 3 years. So that suggests some underlying strength in Europe beyond just the FX noise. It means the whole market isn't just about currency.
Perhaps not solely. But ignoring the direct hit from a stronger euro feels risky. A 10% rise in Euro-USD, the report suggests, can knock 2 to 3 percentage points off Europe's aggregate EPS. That directly impacts the big international companies, the GSTMR types, and that surely limits the overall market performance. So, to me, this mandates very strict selectivity. You have to prioritize those domestic firms, maybe those benefiting from a strong euro internally, and it puts a ceiling on the broad market upside the report maybe hints at initially.
Right. So given these macro shifts, a falling dollar potentially, China moving from pure growth to more of a deflationary competitor, how should investors position strategically across European sectors? What's the right balance, you think, between cyclicals and defensives now?
Well, looking at the report's recommendations, it leans into specific areas. It suggests an overweight in banks, telecoms, tech, and retailers. And, significantly, this fiscal infrastructure theme.
Companies set to gain from higher fiscal and defense spending, especially thinking about Germany, that looks like a key opportunity. These sectors seem to offer a mix of resilience and growth tied more to domestic policy and essential services.
Sure, and I agree on the potential in those targeted areas. But we also have to heed the report's warnings elsewhere. We're already seeing pretty mixed results from cyclicals, and some of those China-exposed segments are definitely underperforming. The underweight calls on autos, chemicals, basic resources, energy, they directly reflect these changing macro conditions. And with Brent crude expected down in the low $50 by late 2026, the argument for a more defensive stance in those very cyclical, commodity-sensitive sectors seems pretty strong.
So it seems we agree that navigating Europe now requires a really quite nuanced view. It's about balancing that relative appeal against some very real headwinds, particularly how currency impacts earnings.
Exactly. And for our listeners, these trends aren't just abstract. A stronger euro, well, that affects import costs, consumer spending patterns, increased fiscal spending in defense or infrastructure that can boost specific industries, affecting jobs and local economies right here. It's all interconnected.
Ultimately, this Goldman report provides vital data, but it also highlights that Europe's moment isn't a simple yes or no. It's a complex picture, demanding ongoing, very precise scrutiny. The opportunities and the risks both require sharp focus.